Mr. Schaffner, the trade conflict between the USA and China is going into its next round. How do you address the risks arising for your portfolios?
The trade war between the US and China is certainly one of the key risks for our portfolio, but also for the global economy in general. We think with the recent developments that both sides are interested in a solution, because when you look at economic numbers from both countries, but also from earnings reports from both countries, it seems to be evident that both sides are suffering on the back of the trade war. I think this is especially highlighted if you look at the Q4 numbers of some US companies like Apple or Caterpillar, but also when you look at some recent economic indicators. So we think both sides are interested in a resolution.
How strong is the influence of the Chinese economy in general on emerging market stocks?
China is certainly in the center of emerging markets, both as a supplier but also as a customer. If you look at smaller countries within emerging markets like Indonesia, Korea or Brazil, they all have a strong dependence on China, and quite a significant part of their exports are exported to China. So for Brazil, this could be commodities like iron ore or soybeans, while for countries like Korea, it would be more high-tech exports.
Now, despite the risks resulting from the trade war between USA and China, you are overweight in Chinese stocks. Why?
Yes, we do our stock selection purely bottom-up. In China, we still find a relatively large number of interesting companies, as China on the one hand is a relatively large market but also diversified market and has a lot of leading companies on offer, companies which might be leading in global niches but also which are leading in emerging markets. And because of the negative sentiment towards China, we can buy these companies at a relatively attractive valuation. Of course, when we do our assessment of a company, we take trade war risks into considerations.
During 2018, the profit projections for enterprises in emerging markets have been cut. What are your perspectives for 2019?
Profit expectations in 2018 were mostly disappointing due to two main reasons. One is the deleveraging in China, which was more or less expected on our side, but which is impacting economic growth negatively. We believe that the deleveraging structurally is a positive factor, as it reduces risks in the Chinese financial system, which should then eventually lead to a higher valuation and a re-rating in the market. The second factor impacting earnings was the trade war between the US and China. The trade war led to a lot of uncertainty, which resulted in companies delaying capex decisions and also consumer postponing purchases of large ticket items. Both had a negative impact on corporate profits at the end.
In 2019?
So when we look into 2019, so we believe the Q1 will be relatively weak based on what happened in 2018. But then if China and the US find a resolution, profit growth and revenues of companies could recover quite fast, as there is a lot of pent-up demand in the system.
In your stock selection process, you include the ESG criteria. Now, in emerging markets, companies have a higher risk exposure to this sustainability theme. How do you deal with that?
Yes, we believe that incorporating ESG factors into the investment process is particularly important in emerging markets. We use it as a tool to better manage risks and also to identify risks. There are like two major differences between developed and emerging markets in terms of ESG. On the one hand, it's more difficult to find information relating to ESG in emerging markets, but also if we try to get information and do the analysis, it's also easier to add value to our investors. The second major difference is that in emerging markets, there is usually a large controlling shareholders, which could pose some corporate governance risk. Therefore, we think it's important to understand whether the interests of the minority shareholder and the controlling shareholder are aligned.
Now, except for China, what are your favorite markets and sectors in 2019?
So the largest overweight we have in China. We also run an overweight in Korea, which is purely bottom up, as we find relatively high number of interesting companies there. Korea is also leading in areas like online gaming, where they start to export their products also increasingly to a global audience, which will be a major driver. We are also overweight in Indonesia, which has done very well in 2018, which now starts to become slightly expensive, but momentum at this point in time is still very relatively good. And one area where we have increased is Brazil, as the new president and his reform proposals are likely to improve economic growth and hence earnings growth in Brazil. So the market starts to look more attractive also from a growth perspective.
Mr. Schaffner, thank you very much.
You're welcome.